In this month's economic update, Kaplan Professional Education's Trevor Treharne speaks to an industry economist about the short-term domestic and global economic outlook.
Welcome to Kaplan Professional Education's monthly economic update. I'm Trevor Treharne, and today we're joined by BT Financial Group's Chief Economist, Chris Caton. Thanks for joining us today, Chris.
That's my pleasure.
With Australia's retirement savings now overtaking the total value of Australia's bank deposits, what are the wider economic implications of having a super system of that size?
Well, it's an interesting juxtaposition because, of course, superannuation savings can be bank deposits at the same time. But yeah, they've grown and grown hugely. I suppose there's two ways you can look at this. Number one, is the system doing what it set out to do? And that is it basically allowing people to provide for their own retirement? The answer to that, I think, is still, well, not for everybody. Essentially for people that began late or didn't save enough, then it's not fulfilling that objective, but you increase the superannuation guarantee levy over time, and we will get to that point. So there's one economic effect for you. There will be diminished reliance on the old age pension as we go forward. But of course there's another question here, and that is, with all this money in the superannuation system, what, if anything, is that doing to markets? And my suspicion is that it's doing less than people think. Now, for a couple of reasons. First of all, it isn't as if suddenly there's an extra, whatever it is, $1.3 trillion going into markets that wouldn't otherwise be. This is, superannuation savings to some extent has replaced other savings. So the net addition to savings is less than the headline amount. That's quite clear. But the other consideration is this, that whatever money is in the Australian superannuation system, it's a drop in the bucket when you think of it in terms of an addition to world capital markets. It's frequently asserted that, because people tend to hold their super money in Australian shares through funds managers, that therefore they must be pushing up the market. Therefore, when everybody decides to retire, which is never going to happen all at once, of course, there'll be a depressant effect on the Australian share market. If that were the case, then you'd be able to look at the price-earnings ratio for the Australian market and see that its trend is higher than it used to be. And you can't see that. So I actually think that this amount of money, when you think of it in net terms rather than gross terms, is less than people thought, and also spread across all world capital markets, is not having much effect. The question is the system doing, or will it do, what it was designed to do?
Do you think Australia's Gen Ys care as much about the economy as previous generations at a similar age?
Well, I suspect that every older generation always looks at the younger generation and says they've got it easy. They don't have to do it tough as we did it. Gen Y, of course, Gen Y in Australia has never known a recession, although they have lived through the GFC. Gen Y, of course, we're told anyway, that essentially have no problem whatsoever with the use of credit. So they're not constrained by their current income in their spending habits. So you put those two things together and probably they do care less about the economy than previous generations, but that's because they've been able to. They still, of course, have to get up in the morning and either go to a job or go and get a job. The economy does still affect them, and it's not easy for the young breaking into employment. It's not easy for the young also when there's this other generation, bigger than they are in number, if you like, who are still working and refusing to get out of the way. And I don't have anybody particularly in mind when I say that.
Economic confidence in the Eurozone improved sharply in August, but unemployment rates remained at a record high. Will the unemployment rate improve, or is confidence more likely to fall back instead?
Unemployment in Europe is so sticky. I used to define a recovery in Europe as a year in which the unemployment rate went up less than it went up the year before. Somewhat tongue-in-cheek, of course. But unemployment is so sticky, and particularly among the young. But there is clear evidence, particularly in the larger economies, particularly in Germany and France, that they're back into positive growth territory. And my suspicion is that the outlook for the Eurozone over the next year will improve. And there have been several indicators relating to manufacturing, particularly the Purchasing Managers Index, indexes that suggest that is so. So, if something has to give there, my suspicion is that unemployment will still be high in Europe, and it'll be high for a long time yet, but probably lower a year from now than it is now.
The US economy is growing at a modest rate. Does that growth rate need to be accelerated, or is a slower tempo better for the long term?
It would be very nice to get faster growth going in what is still the world's largest economy. They've been limping along at around about 2% recently. Some would characterise that almost as stall speed. They've tried pretty much everything they can to get growth going. Unfortunately, the mooted end of quantitative easing has driven up mortgage rates and has taken the one thing that was showing huge signs of life, namely housing, and at least slowed down the recovery there. Plus, they've had to deal with the sequester, the mandatory cuts in federal spending, and they've had to deal with severe budget pressures at the state and local level. It's not generally known, but since 2009, the US economy, the private economy, has grown by 3%, but the weakness of the government sector has dragged all of that down to 2%. Now, the government sector is looking a lot better, so presumably at least that drag will be less going forward. Now, I think it's likely that the US economy will accelerate on its own, and that will be a positive. But we're not talking stellar growth here. The last time the Federal Reserve put out a forecast for 2014, they said 3.5% growth. It might do somewhere between 1.5 and 2 this year. Nobody else believes that 3.5 for next year. I think the optimists are probably somewhere between 2.5 and 3. So in sum, there are a number of forces at play there, but growth should pick up of its own accord. But it'll be like the rest of the world. The US is pretty much stuck in a slow growth trap.
The Asian market has been impacted by some investors turning their attention back to the improving Western markets. How can Asia manage this shift?
Yeah, it's quite clear. The emerging markets in Asia are probably down, and this figure is rough, but say 10 or 15% since the start of the year, and developed markets are up by a similar amount. So the dichotomy has been huge. And one factor that has been pointed to is that that quantitative easing in the US pushed down yields in the US to such an extent that money fled the country in the search of any yield anywhere. And now that the talk of the end of quantitative easing has turned that around, the money's coming back, which is basically, so the many emerging countries are in capital outflow, and this has obviously, it's a negative for their markets, etc. What can they do about it? Not a lot. They benefited on the way up, and now they're losing it on the way down. There's not a lot they can do. Importantly, the capital outflow and certainly the state of foreign exchange reserves in emerging Asian nations it's a lot different from the Asian crisis in the late 90s. So we're not going to see a replay of that, in my view. But yeah, for some emerging market countries, India in particular, China not at all, oddly enough, this has become an issue.
Thanks for your time today, Chris.
It's been my pleasure.
And that brings us to the end of the October PD sessions. Thanks for watching. If you have any feedback or questions, please drop us a line at pdcontent@kaplan.edu.au. I'm Ron Wilson. See you again next time.